Hello, everyone. Welcome to our latest video. This is our first of what we're calling our clear path videos, which is to help identify the paths to go through the times that we are in. And in our first episode, this is entitled Stocks Won, because of a piece that we will feature here in just a moment. As I get into this is just a really simple idea, and it really begins with investors and particularly investor fear. And there's a lot of things that bring about investor fear. One of them is to deploy cash in a down market. It seems that of all the things that go on sale periodically, all of us tend to like sales. One of the areas that people are challenged with taking advantage of a sale is when stock prices are discounted, seemingly should be attractive to investors, yet they aren't because there's a concern that things are down, so we don't want to invest now. So what this is going to look at is we're going to look at the other fear that people definitely have, and that is if they do have cash and they are going to invest, the fear is, well, I don't want to invest at the market height. That's for sure. And what we're going to look at is a piece that First Trust put out, which really looks at that closely, and the results, I think, might be a little bit surprising to some of you. So here we go. So here's our piece from First Trust, and what this is looking at, if you look at the bottom of your screen, we're looking at stocks, gold, treasury bills, all the way across to cash and oil. And what this is looking at is investing money at the height of the market that went up between 2002 and 2007. There was a 5-year, it's called a bull market. It was an up market. That market topped out on October 9th of 2009. I'm sorry, I misspoke, 2007, October 9th, 2007. And what this is looking at is to say, hey, if you invested in each of these asset categories at the height of that market, right before the 2008 financial crisis, which asset category would have done the best, and what kind of results would they have provided? And what you can see in this is stocks, if you see that on the lower left, averaged, putting in at the highest point over the following 15 years, stocks went up 8.5% on average compounded annual returns. Really remarkable. What it resulted in is in the pot of money that would have been invested in the United States stocks would have gone up over 3 times during that 15 years, even walking straight into a 57% decline. So here's what we learned from this, is that had an investor invested at that high point in the market in 2007, they end up coming out really well. But we're not in those times right now. And this is the second point. We've got stocks significantly discounted right now. So the opportunities before any of us who might have cash to deploy now are better in the next 15 years versus this example that we've shared that still worked out really well for the investor. We're going to keep providing information to hopefully help and guide and strengthen confidence during this time. Thanks for tuning in.